you guys once again. Today we'll be having valuation of inventories. Welcome to this channel, Accounts and Business Made Easy. Inventories can be valued in several ways and by different businesses. But if you are watching me today for the purpose of exam preparation, we'll be talking on two methods of valuation of inventories. But for general reasoning, valuation of inventories has three methods, and they are FIFO, LIFO, and AVCO. For exam purposes, you will need to dwell on FIFO and AVCO. LIFO is not often used for exam purposes. Now, starting with LIFO is last in, first out. FIFO is first in, first out. First in, first out. LIFO is last in, first out. Then we have AVCO. AVCO is weighted average method of evaluating or showing the values of our inventories. You know, for different reasons, the inventories that are kept from the beginning of the accounting year of a firm till the end of the accounting year of that firm will be showing different values for a firm. Hence, using following consistency concept of accounting, that any method of inventory valuation we want to choose, we must stick to that method. That means if it is FIFO a firm will be using to show its value of inventories, it must stick to it. And if it is AVCO, it must stick to it. And if it is LIFO, which is not often used and it's not even used for exam purposes, but for knowledge sake, we'll do it in this class today. That's LIFO. Now, I will write an example here, and together I will explain it, and together we'll do it. So this is an example of the movement of inventories to a firm at a certain date. So on June 1, let's put a date: June 1, June 2, June 3, June 4, and June 5. So if on June 1, 500 materials are bought in at $2 each, on June 2, bought in another 300 materials at $2.1 each. Then on June 3, sold 420 goods. On June 4, bought 120 materials at 2.6, and on June 5, sold 300 materials at 2.9. Now, the value of inventories left at the end of June 5, for instance, will be different using different methods of valuation. So let's start with FIFO. Using FIFO, we want to show the value of inventories that is sold and the cost of inventories sold and the value of inventories left. So using FIFO, bought in 500 at price at $2. So value would be 1,000. That's June 1. This is date, this is details, this is quantity. Now, on June 2, bought in 300 materials. 300 materials at 2.1. 2.1 times 300 is 6,200. So at this point, there are in value 16,200, and here you have 800 goods. Then on the next day, you sold 420 materials. Now, here is where we have the technicalities. We are using first in, first out. That means the 420 materials that are sold out must be taken from the goods that entered the firm first. That's where we get the name first in, first out. Goods that came in first in the batch would first be sold out. So that means from the 500 goods that were brought in, 420 will be sold. It is until we exhaust these 500 that we will get to be selling 300 goods. That means on June 3 sold 420 goods. That 420 goods will be at the value here, at the value of the 500, because that's where we're selling from. So 420 at $2, price in dollars. 420 times 2 is 840. So 16,200 minus 840. So this is 0, 6, 4, 5, 1. 15,460 goods are left. And on June 4, bought 120 materials. Bought in 120 materials. So it's added to the okay, so this is 380 left, was we sold here. So 380 that is left here plus 120 will increase the value of goods that we have to 500 units. Then bought in at how much? At 2.6. Please, 2.6 times 120. 312. Yeah. So 312. So 312 plus 15460.
312 plus 15460 15772.
So at this date, the value of inventories left was $15,772. But lastly, we sold on June 5 300 units. On June 5, sold 300. So this will be left with 200 units of goods. But the value of goods, okay, we sold it. The value of goods will be, okay. Okay, now we are still using FIFO. So the value of this 300, remember we are using FIFO, first in, first out. From the first 500 that was purchased, 420 has been sold. So that means from the first 500, 80 is remaining here. But we sold 300. That means that 80 is first taken. Then the other 220 would be taken from this value. That means the value of the 300 sold is 80 at $2 and 220 at $300. It means that the cost of the 300 sold is the cost of purchase, which was $2. Remember, 80 are still left here to be sold. So we first sell that 80 at $2, then we'll sell the remaining 220 at $2.1. So 80, then we'll do short calculation here. 80 times $2, then 220 times $2.1. 80 times 2 is 160. 220 times 2.1, please. 220 times 2.1. 462. So that means the value of the goods sold here is 226. So 622. So 15772 minus 622.
15772 minus
622.
15150.
15150. So there is working one here. The working that we did here. Working one. The answer here is what we took here. Now that means using first in, first out. The cost of the value of inventories at the end of the period is 15,150, but the units of goods left is 200 units and the value is 15,150. For the cost of goods sold, here the cost is 420 times $2. Then for cost of this, it is what we did here. This is cost of the 300, and cost of 300 is 622 plus cost of the first 420 that was sold. That will give us the value or cost of goods sold. The value of closing inventory is 15,150 using first in, first out method, which is FIFO. So we are using the same information to prepare LIFO, last in, first out. So almost the same thing, only that when we get to goods sold, we have to look at the values of batches of goods as they come in last. You take goods from the last batch before you go to the earlier batch. Often the businesses that can often use this are firms that deal with cargo. You know, in shipping, you load, you stock inventories. So when you get to the port, you first withdraw out, you first take out the goods that enter last. Do you get it? In cargo or in shipping business, the items that enter last are the ones you first offload. Do you get it? So that means LIFO can often be used for businesses that deal with shipping, but oftentimes and for examination purposes, LIFO is not, and in many businesses reality case they often use the LIFO method.